You can understand from my tone which direction am I leaning towards. I will give you all the facts. Final decision is up to you whether you want to invest or not. But there are three critical things that you need to remember, irrespective of whichever finance stock you are looking to buy as of now. Hi everyone, welcome to today's video. So on Friday, HDFC Bank's group stock, it fell by roughly 6%. Now, if you check some of the other finance or finance oriented companies in India, for example, consider the case of Aavas Financiers, which is one of the fastest growing housing finance company in India. Its stock has corrected by roughly 60%. 60%. Now the interesting part is that you might think that, there is some fundamental issue going on with HDFC Bank or Aavas Financier is having some kind of a fundamental meltdown. No such thing. Actually, these companies are sitting on their highest ever profits, highest ever revenues. So take a look at HDFC Bank's profits and revenues, and same applies to Aavas Financiers. That these companies are sitting on their highest ever profits and revenues, and still these stocks are correcting quite aggressively. So this is part one. Part two is that many people are now assuming that, there is some kind of brewing crisis in the US, that a lot of banks in the US are collapsing, and now that crisis is hitting the Indian shores. And the start of collapse of HDFC Bank and Aavas Financiers is just the beginning. So on this video, I'm going to help you fundamentally understand this topic by doing a macro and fundamental analysis of not only these stocks, but the entire banking crisis that is happening. I'm also going to project or slightly indicate what is going to happen next. And if you are an investor in any of these stocks, or if you want to build position, consolidate more of your positions, this video becomes extremely important. One humble request that if you like these type of macro videos, do consider liking this video. It would indicate to me that you would want me to make these type of macroeconomic oriented topics, because these days anyone can stand up, give a lot of viewpoints. I have to research quite a lot, study a lot to bring all this commentary to you. So a simple like from your side would indicate to me that you like these type of topics. Also, a very big shout out to our sponsors for today, which is Ditto Insurance. Now, when it comes to banking stocks or generally your stock portfolio, it can correct. You will always get an opportunity to rebuild your portfolio. But if something happens to you and if your family depends on you and you don't have a term insurance, then it can prove to be catastrophic. So the good thing about Ditto is that they don't do any push-based sales. You can easily call up their expert, discuss about your insurance needs with them, absolutely free of cost. So please use the link in description and comment box to schedule a free phone call. So let's begin our topic, and let's first and foremost understand the dynamics as to what is happening in the US. So I will present a very quick commentary there. So back in March of 2023, two major US banks collapsed. One was Silicon Valley Bank and another was Signature Bank. Both of these banks were reasonably sized bank, but they completely collapsed. After this, the central government got active and their central bank also got active, and they extended something called as deposit guarantee program. Now, according to this program, what they basically said was that in the event of a bank failure, the central government and the central bank in the US, they are going to stand behind the bank and the depositors will not lose money. So for a period of roughly 1 month, everything was going fine. And then suddenly another piece of news started cropping up, which said that there is another bank called as First Republic Bank, which is going under. So within a span of 1.5 months, despite all the extensive efforts made, there were 3 banks that went under. That started creating a little bit of problems, especially given the fact, and here is the balance sheet of First Republic Bank, and you will see that up until 2022, this bank was doing exceedingly well when it came to finances. For example, they had no deposit problem, everything was going fine, there was no major issue per se, but despite all that, this bank went under. So this brings us to a series of questions. So the first central question is that, okay, what exactly happened that these banks went under? Second, and more importantly, will this destabilize the banking system all across the globe? And third and finally, is it already creating a negative impact on the Indian banks? So what are the similarities, dissimilarities between these crises and the Indian and the US bank? It becomes extremely important for us to grasp this point. Because if we don't grasp this and if we keep on throwing our money in the stock market, every time there is a 5, 6, 7% shake off in any of the stocks, we will start panicking. So just today, I ended up receiving so many comments and messages from my community members that, okay, what is happening with HDFC Bank? Is it going to go under, vagera, vagera? So I had to give out a quick commentary on that topic. In case you want to avail all this commentary, because it is impossible for me to make very quick videos and release it on the same day, but I do make important announcements, whatever is happening in the stock market on YouTube member community. So you can definitely check it out. The The link is given in the description and comment box. So, okay, over to the fact that what exactly is happening in the US banks and why is the crisis happening and whether or not something similar can play out in the Indian ecosystem. Let us quickly analyze that. So as you already know that the interest rates in the economy, be it in India, be it in the US, it has been going up since almost November of 2021. And over the last 1 year, since the interest rates have gone up quite substantially, it has created a series of impacts for different type of banks. For big banks, it is hitting this rise in interest rate. It is hitting them differently compared to smaller banks and special regionalized banks and also banks that deal with specific kind of customers. There are two major impacts that this rise in interest rate has caused for banks that have collapsed. So let me contextualize that to the American banking crisis that is going on. So the first key change that happens due to the rising interest rate is that the depositors, people who are putting their money in these different banks, they start to expect more returns on the deposits that they are making. For example, think about it this way, that right now, if you go and avail an EMI on your loan, you will get a very high interest rate on your loans, right? For example, if you're taking a 1 crore rupee loan right now, the rate of interest might be 9 or 10%. But had you taken the same loan roughly 1.5, 2 years back, you would be getting that same loan at 7.5% also. Same applies to fixed deposit, that over the last 6, 7, 8 months, the fixed deposit rates have gone up quite dramatically compared to what you were receiving up until 1.5 years ago. So what exactly is happening? Well, to cut the long story short, if you're going and depositing your money in the form of doing fixed deposit or in any format, you would be expecting that the bank pays you out a higher interest rate. So this interest rate payout becomes a very important aspect. So this is the first key change that is happening. The second key change is that due to the increase in interest rate, it hits the asset mix of the bank very, very differently. Now, what is the meaning of assets for a bank? For example, you might have seen that banks, when they take, let's say 100 rupees from you, what are they going to do with this 100 rupee? They might be able to loan out, let's say 80 rupees, the remainder 20%. And I'm just simplifying the example here, that remainder 20%, they might go and invest in something. For example, they might buy something called as T-bills. Now, these are safer assets. Or they might go and invest someplace else. So what are they doing? These all different things, these are assets for the bank. This is an asset. A loan is also an asset. So with the rising interest rate, what ends up happening is that number one, because the banks might be getting higher deposits, they have to go and give out higher risk loans. That's part A. Part 2 is that they might be investing their money in all these different asset classes, which itself is getting hit differently due to the rising interest rates. Now, something similar happened with Silicon Valley Bank also and Signature Bank as well. For example, here is the balance sheet of Silicon Valley Bank, and take a look at this. This is a very important point because this will help you understand the banking difference between the US and India right now. So what you will see is that they have something called as HTM or held till maturity security. This is the entire balance sheet of Silicon Valley Bank. Their total assets were $200 billion. And out of this, approximately 50% has been in held till maturity securities. Now these HTM securities are safe assets. These are safe investments. These are basically government bonds. So it's not as if that you will lose money on these HTM securities, but their nominal value means that, for example, today you buy, let's say, a 300 rupee share of ITC, and suddenly tomorrow in the market something happens and the stock price falls to 280 rupees. Now your real loss is how much? Your real loss is 0. Why? Because you have not booked your loss. But your nominal loss is how much? Well, it is 20 rupees. Why? Because the asset that you hold, which is ITC stock, it has fallen in value by 20 rupees. Therefore, your nominal loss becomes 20 rupees. Now, something similar happened with the Silicon Valley Bank also, that the assets which they held, which are HTM securities, these are safe securities. You will not lose money if you hold them till maturity. HTM means held till maturity. So they might have a maturity period of 3 years, that after 3 years, you are going to make $100 per bond that you are purchasing, right? So that's the stated amount that might have been written. Now, if the banks are able to hold on to these assets for a period of 3 years, they are definitely going to make $100 on it. But meanwhile, what happened is that due to the rising interest rate, there was something called as yield curve inversion. I had made a separate video on Silicon Valley Bank crisis. I will link it down. Please go and watch it in case you want more understanding on this. But very quickly explaining that in yield curve inversion, what happens is that short-term debt becomes much more attractive than long-term debt. So long-term debt, something like HTM securities, they go down in nominal value. And how much loss did Silicon Valley Bank take due to this going down in nominal value? Well, they ended up taking a nominal loss of $15 billion. Now, when investors came to know about it, depositors came to know about this, कि यार $15 billion का loss हो रहा है. So what did they do? They did something called as bank run. Now, bank run simply means that they started going to the bank and started asking for their money back. This is just one aspect of it, that due to the loss, people started demanding money. There are other aspects. For example, Silicon Valley Bank was a very highly concentrated bank. They mostly catered to startups. And these days you might be seeing that there is funding winter going on. Startups do not have money. So whatever funds they had with Silicon Valley Bank, they started saying, boss, please give us our money back because we are unable to pay our employees. We need that funds right now. We are unable to raise it from other sources. So we need the money that we have given to you. So there was a kind of a bank run situation with Silicon Valley Bank for a wide variety of issues. But two major ones was that there was an asset concentration risk, that they had invested almost 50% of their assets in one single instrument called as HTM, long-term securities. And the second major risk was the client concentration risk. And as a result, this bank went under. Now, do Indian banks also suffer from similar type of an issue? The short answer is no. And just to help you understand, here is the customer categorization of HDFC Bank. What you will notice is that almost 46% of HDFC Bank's business come from retail banking. Retail banking simply means that these are a series of customers. These are like customers like you and me, good paying jobs, etc, etc. So 46% business comes from here only. Then you have wholesale banking. Wholesale will mean commercial banking, business, family office. So these are different type of customers, and there will be treasury functions, vagera vagera. So to cut the long story short, the Indian banks, you will see that they are mostly retail focused banks, and they have wider customer distribution compared to Silicon Valley Bank. Now you might say that, okay, you are just handpicking an example here. What about other banks that have collapsed in the US? Okay, so let's look at the customer diversification of Signature Bank. So here is what is said about Signature Bank, that this is specially known for catering to law offices, real estate buyers, cryptocurrency companies. So again, this was slightly more concentrated bank. Yes, Silicon Valley Bank was extremely concentrated. Signature Bank was less concentrated, but when it comes to Indian major banks, they are highly diversified. Now the second risk which is not there with Indian banks is the HTM buying securities. For example, I showed you the balance sheet of Silicon Valley Bank, and approximately 50% of their assets was tied in held till maturity securities. Now, can you do something similar in a country like India? The short answer is no. Now, this is a very good article. I will link it down in the description and comment box. You can go and read it. But as per this article, Indian banks are currently allowed to hold HTM bonds only up to a limit of 23% of net time and demand liabilities. So in India, banks like HDFC Bank can't go and buy like 50% of their asset concentration just in held till maturity securities. So now you might have a counter question that, okay, I have heard of something called as domino effect in the banking system. Very quickly, what it means is that, for example, if Silicon Valley Bank collapses, then because of the exposure that Silicon Valley Bank might have on the economy, even other small regional banks might collapse. For example, Signature Bank might collapse. Now, which in turn might create a snowball effect, and bigger banks like JP Morgan might collapse. Now, if JP Morgan collapses, then it could create a worldwide meltdown. And something like HDFC Bank, ICICI, Kotak, even they will start going under. Now, this is something that happened in 2008. But if you go and study the 2008 crisis, what type of crisis it was? Well, it was a type of crisis where banks like JP Morgan Chase were hit. For example, Bear Stearns, Freddie and Fannie Mac, all these different banks were large commercial banks. They had very wide distribution base and they were dealing with toxic assets, so to say. Now, when large institutes like Morgan Stanley, JP Morgan, all these big banks which have very diversified operations similar to HDFC Bank, if they go under, then definitely we have a very big contagion risk here. But so far it appears that the contagion risk is not spread here. It is only up until here. Now, even in this region, the US government is very proactive in terms of not letting this crisis go out of hand. So let me share two very important data points. The first data point is of JP Morgan, just to outline the entire perspective that this bank is somewhat safe as of now. And you can study this by looking at the financials of the company. The company is sitting on its highest ever profits, highest ever revenues. And these are very, very strong results. In fact, JP Morgan, even in the stock market, is doing fairly well. So there seems to be no risk there. So that's part A. Part B, if you actually go and ask the question that, hey, how is this part of the supply chain being handled? And what is it that the US government is doing to avert the crisis here? Are they doing something, or will this crisis go to 100 plus US banks and eventually it will go and hit a bank like JP Morgan? Are the chances of that happening high or low? Now, of course, the regulators are not going to divulge the details there. So we have to use our brain as investors. So according to me, this is what the macroeconomy tells us. So you need to understand the fact that at what rate the interest rates are risen in the economy. So back in late 70s and early 80s, there was a person called as Paul Walker. And what he was responsible for was that he was responsible for dealing with the inflation situation in the US. What he did was that the average interest rates during that time was approximately 11.2%, and he brought the interest rate all the way up to 20%. Now these are fairly high interest rate. Now, if something similar happens in the economy, that the average interest rates in the economy were 5% and this was brought to 15%, the economies are going to crash. Even the Indian economy is going to crash and the US economy is going to crash. Good part is that right now, it seems like that we are peaking in terms of rise in interest rates. This is something that I've been saying over and over again, and I've been fairly correct in terms of doing this assessment. So you can go and check my video 6-7 months back also. I told you that the interest rates are going to peak by mid of this year, and that is precisely what is happening. And the indications are now that the interest rates are going to get cut. So this entire interest rate issue, which has caused the banking collapse, that seems to be in control. So this is the first critical step that has already been taken. It is very, very unlikely that the interest rates are going to rise from this point. So therefore, it becomes an excellent time for investors to wrap up their portfolio building stage and be done with it. Let the interest rate falls from this point. That is when you are going to make the most money. I am hoping that by next year, this stage should get completed, and that is when you should start your profit booking. Again, I will give all my calls, what I'm buying, what I'm selling on the member community tab. You can definitely check it out. So this is the first critical issue that seems to be solved in the economy as of now. On top of this, the US government has also launched a US funding program, which again is a very simple way of saying that, you know what, agar koi bhi crisis hoti hai in the US bank, the government is going to stand by that and they are going to extend an unlimited line of credit in a way to support that bank. So the customers need not fear. And somewhat it seems like that the concerns have been alleviated to a very large extent. So now you might have a natural final question for me that, okay, is this a great time to buy something like HDFC Bank and Aavas Financiers? What is your viewpoint? Okay, so I'll be a little bit cryptic here. You can understand from my tone which direction am I leaning towards. I will give you all the facts. Final decision is up to you whether you want to invest or not. But there are three critical things that you need to remember, irrespective of whichever finance stock you are looking to buy as of now. So the first critical point is that you need to understand the horizon for which you are comfortable holding a stock. Consider, for example, HDFC Bank. If you are a long-term investor in HDFC Bank, you need to study the long-term graphic of this particular bank. So there is a very clear head and shoulder pattern or reverse head and shoulder pattern, and it categorically gives the target of roughly 2200. So this is the point up until which I am going to hold HDFC Bank. So this is my viewpoint. I already have big position. I'm already on profit on HDFC Bank because I started building my position when HDFC was trading somewhere around 1520, 1530. So this is one. Now, if you're of the view, yeah, I want to hold it only for a short term. So again, there is a good pattern that is forming here. And if you zoom it out, you will be able to see this clearly. So again, even from a short term, it looks okay to me. This is the technical commentary. Second, you need to relate it to the fundamental commentary. Please go and check whether the stock that you are considering, what type of sales growth and profit growth it has had, how it is going to get impacted by debt. For example, again, taking you back to JP Morgan's commentary, JP Morgan as a bank is doing phenomenally well. Why? Because it is a very big bank in the US. In fact, it has acquired one of the fallen banks. So what is happening in the macro ecosystem is that small banks are falling, big banks are coming up and they are taking them over. And in the future, they are going to grow their business even further through these cheap acquisitions. Now, something similar is with HDFC Bank. That HDFC Bank is a very solid bank, solid numbers, fundamentally good. In case some of the banks in India also die, smaller ones, HDFC Bank might go and actually acquire them. So this is actually a good time for big banks. So please check the stock fundamentally. Third and finally, because these stocks are falling, you need to be clear about the reason for the fall. Now, I will not tell you the reason for why AU Small Finance Bank is falling, but I will leave you with a very interesting commentary on why HDFC Bank has fallen, and you tell me whether it makes sense or not. HDFC Bank has fallen on Friday's trade for the simple reason that there is an index called as MSCI, and what it has done is that it has made the announcement that, hey, we are going to rebalance our portfolio, and as a result, the weight of HDFC in our entire index will be cut from 18% to somewhere around 15%. And because of this, there will be an outflow of $200 to $250 million. What am I trying to say in simple words? Well, in very simple terms, I'm trying to tell you that a big investor is going to sell $200 to $250 million worth of HDFC Bank's stock. Now, what is the market capitalization of HDFC Bank? You tell me in the comment box that what is the size of HDFC Bank and whether or not selling of this $250 million, is it a big deal? Is it not a big deal? That's part A. That's a decision that you will have to make. Second, and more importantly, that okay, cool, some big player is selling it. What do you think is going to happen at the buying side? Will people want to buy HDFC Bank? Or will people would not want to buy HDFC Bank? What are they going to take a look at? Well, they are going to take a look at the growth prospects of HDFC Bank. If the bank is already solidly capitalized, if there seems to be no major issue, they are going to pick up the stock at that particular price. Yes, 5-10% fall can happen on any stock at any given day. No one can stop you from doing that. But you need to understand how a pertinent piece of news is going to impact a stock. Whenever a stock corrects by 5-7%, it could be a great time to aggregate that stocks if it fits your investment horizon, if it fits your portfolio, and you are reasonably sure कि यार आगे चल के 5-7% गिर भी गया, if it falls by 5-7% more, I will still continue to hold my position or build more on it. If you are working with that assumption, if you have that level of clarity and understanding, definitely you could consider building some position. Otherwise, learn more about the stock market and then finally build your positions. Unless you yourself have conviction, you will never make money in the stock market. I hope you enjoyed this conversation. If you did, do press the like button and I will see you soon.